folks, right now we're having a major sector rotation. Now, what does that really mean? That means that stay-at-home stocks are kissing the toilet, for lack of a better term, and back-to-normality stocks are rising, and they're rising really well. Also, industrial stocks are rising. In a nutshell, everything that was turning into a 52-week low 8, 9, 10 months ago is now making 52-week highs. All the surveys, everything is talking about the world reopening again. So the question is, where do we put our money right now? Where's the smart play? Where's the sensitive play? And that's a tough question to answer, and I'll tell you why. Markets, especially tech, large cap techs that were running wild in 2020, are sheepish right now. They're somewhat bearish. They're trading below the 50-day moving average or at the 50-day moving average and are strongly lagging behind the S&P 500, the Dow, and the Russell. And you always want to be swimming with the current. You never want to swim against the current because it's going to be that much harder to swim. And in this case, it's going to be that much harder to make money. So you always want to be with the stocks that are in the overall uptrend. So I've got something really, really good for you today, and I think this is going to benefit you. Right now, there's a huge focus on interest rates. And right now, what you're looking at is actually the 10-year note, which trades inverse to interest rates. And in the last few months, look at this. This thing fell off the cliff. Interest rates, which are inverse to the bonds, again, they're opposite. So as bonds fell from 155 to 136, this is the 10-year, the 30-year note did the same thing. We saw interest yield on the long bond go from 0.93 to 1.5%. And that's causing concern with investors, especially when it comes to large cap tech. So everybody's thinking, where should we put the money? What's the next step? How do we profit from this government stimulus? And one Biden stimulus trade being recommended right now that I really like is playing discounters. That's right. Let me give you a good understanding of this. Look, the current administration is focused on reinvigorating the economy and addressing social inequality rather than bolstering asset returns, right? Trump's administration wanted to help the rich and preserve the poor, or whatever about the poor. I'm not going to get into politics. But Biden administration has a very specific agenda with all the stimulus. They want to focus on inequality. And Bank of America analysts, which are big in the consumer discretionary sector, are quoted just last week. They said, we recommend discount over luxury retailers, supported by the potential for minimum wage hikes for low-income workers and tax hikes for wealthy individuals, right? This administration is more than likely going to help the poor and tax the rich. That's what Democrats do. And again, I'm not going to go deep into politics. The firm notes that discount is underweight by active managers relative to luxury stocks and points to attractive picks in the current environment. And I'm going to tell you folks, Bank of America is very savvy when it comes to consumer discretionary stocks. And what they're basically saying is, hey, the market is going to go higher, but over the next few years, the people who are going to benefit the most is not going to be the rich, but it's going to be the poor or people in the lower end of the economic echelon, okay? This isn't an argument rich versus poor or poor versus rich. What they're saying is this administration is going to help people, companies, to get back on track before the rich get to benefit. And that's okay. I get it. I'm not going to argue with that. But the bottom line is it's a very interesting approach to economics. I was talking about the energy market heating up a few days ago in one of my classes. And I said, hey, if you guys want to focus on energy stocks, don't focus on the big companies. Focus on the companies that are running the gas stations, because those are the companies that are going to benefit first. Then you're going to have the middlemen. Then you're going to have the Exxon Mobil. So the benefit when the economy starts going back up, the beneficial cycle of economic demand tends to work better from the little guy back up to the big guy. And that actually goes in line with what we're talking today. So I'm going to show you a handful of stocks that Bank of America is recommending right now that they believe will outperform. So in other words, they're saying if you're going to be investing in restaurants or shopping stores, Go for where the guy with the little money shops. Don't go for where the rich man shops, for lack of a better words. So let me focus on some stocks that I'm really liking right now in that theme and how this can help you benefit with the coming stimulus money that's coming into everybody's pocket and with the summer coming up when people actually spend a lot more money. People are looking to go out, shop, spend money on foods. But again, let's focus on making money from the little guy, not from the big guy, because that's going to impact the economy first. And the big guy is going to be last. The wholesaler, the middleman is last. The retailer is first. So first place, Ross stores, right? It's a discount shopping. Ross doesn't sell $1,000 handbags. That's not the kind of store. It's a discount retailer. And right now, if you look at the price, it just made a swing high. It's trading above the 50-day moving average, and I like the price action. If we look at it on a long-term basis, it's actually making almost, look at this, a multi-year high, and certainly trading higher than the February breakdown that we saw last year. So Ross stores definitely one stock on my radar. And they have a companion, TJ Maxx. Oftentimes, you will see Ross and TJ Maxx next to each other. And when my kids were growing up, and when they needed tennis shoes, and I knew I was going to buy another pair of tennis shoes like a month and a half later because their shoes were going to grow, my wife would just go to Ross or TJ Maxx and spend half the money. But a lot of people, especially right now with the economy opening up, those are the stores they're going to be shopping at. The stock just made a swing high less than about a month ago, a little less than a month ago. It's now trading above the 50-day moving average. I would wait for a little more clearance above the 50-day moving average, but I like this stock just like I do Ross store. And finally, in terms of the stores, discount stores, we have Kohl's, which guess what, is making all-time highs. And it fits perfectly into our story that lower-priced retailers and lower-priced restaurants, chains, are going to be the ones seeing the pickup in the economy first before it hits the middleman, the retailers, or the luxury goods and luxury expensive restaurants, so to speak. And there's really not that many expensive restaurants that are chains now that I think about it. But let's talk about another retailer, Dollar Tree. This was a big one, especially in parts of the country where you have bedroom communities. There's a lot of Dollar Trees. The stock made a recent high. It's trading above the 50-day moving average. If you want a little more safety, wait for it to trade above the 115 level. But I think we're going to see some upside, especially with the stimulus checks coming back and giving individuals and families money. And remember, these stores like Dollar Tree, they sell a lot of necessities. So it's not just clothing, it's also things that you need, like toiletries and so forth and so forth. Now, let's get to the foods, right? Now, we all know McDonald's. When people don't have a lot of money and they're starting to get paid, where do they go? McDonald's. People love McDonald's. Even I sneak in a McDonald's, a Big Mac once in a while. Now, what I like about McDonald's right now is it's been congesting right at the 50-day moving average. And if you know anything about how I like to talk about analysis, I like to see a nice horizontal, vertical move. And I'm seeing a nice vertical move developing in McDonald's. This is a 9-month chart. And I believe with all this congestion, the stock is going to hit the swing high here. So I would wait till we get to the 230 level, but I believe the stock is on its way up. And finally, we've got Yum Brands. Very similar pattern. Notice this congestion. This usually leads to a nice fat breakout. And if you look at Yum Brands, you will see they've got their hands in all the low cost junk food and low KFC, Pizza Hut, Taco Bell. I mean, just right there and then, they've got like 3 out of 4. If you combine that with McDonald's, you've got a good recipe for upside. The stock is up over 56% over the year. Technically, it's looking good. And I like the fact that both McDonald's and Yum are coming out of these long or extended congestion patterns. Breakouts tend to be very strong when the preceding price action was horizontal. And in this case, we've been going horizontal now for 4 months now, for over a quarter on Yum Brands, and on McDonald's, about 5 months. So usually, typically, unless they break down, they'll break to the upside pretty hard. So again, we got Yum Brands, YUM, McDonald's, MCD, Dollar Tree, DLTR, Kohl's, KSS, TJ Maxx, TJX, and Ross Stores, ROST. And I like all 6 for where the economy is going, where the stimulus check is going to hit, and where I'm seeing things develop in the consumer discretionary sector. Buy companies that profit from low income or from that sell discount merchandise. Hope that helps.